if you know nothing more about Elliott, then 3 up and 2 back is good, and 3 down and 2 up, that's great for a short. That's all you need to know. Trying to label charts from 1865 is a complete and utter waste of time. And even Bob Proctor says that his work is very academic. It's not that much use for being a trader.
That's David Paul, decades in the markets, and his verdict on Elliott is blunt. Labeling charts back to 1865 is a waste of a trader's time. But notice what he refuses to throw away. 3 up, 2 back. 3 down, 2 up. He keeps the structure and drops the obsession. That distinction is the most useful thing anyone will ever tell you about this theory, and it shapes everything in this lesson. Because Elliott has 2 layers, and they don't deserve equal attention. There's a small core, the part David Paul kept, 5 waves out, 3 waves back, and 3 rules that tell you whether you're reading it correctly. Then there's a much larger layer of classification, degrees, subtypes, combinations, a name for every shape price can make. I'll teach you both, and I'll tell you which is which as we go. The core is what you learn and use. The rest you don't memorize. You learn to recognize it, and you come back to it when a chart demands it. So today we're continuing our technical analysis for day traders, from basics to advanced series, with the theory behind that rhythm. This is part 1, and it's the anatomy. Motive and corrective waves, how they build a full market cycle. The 3 rules that decide whether a count is valid at all, and every shape price can form inside a correction. Part 2 takes it to the chart. Fibonacci projections in price and in time, and a complete trade read from setup to reversal. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. So why does this matter to a day trader? Because a wave count answers the one question that decides every trade. Where are we in the move? Knowing whether price is opening an impulse or closing out a correction is the difference between anticipating the next leg and reacting to it. And that single shift is what sharpens your timing and keeps your risk defined. Everything here is taught on real charts, not textbook diagrams. We'll build this on charts, not just on textbook diagrams. And we'll use TradingView, since it's the platform most traders already have open, and it's easy to get started with. Just keep in mind that different platforms display price data and wave tools in slightly different ways, so spend a few minutes with yours. The principles carry over. The buttons don't. Before we get into the mechanics, it's worth knowing who Ralph Nelson Elliott was, because his background explains the theory. Elliott was an American accountant, trained to find order in columns of numbers. In the 1930s, after years of studying stock market data, he arrived at a conclusion that contradicted everything the market appears to be. Prices don't move randomly. They repeat. And what repeats, he argued, is the collective psychology of the people trading. He called those sequences waves. He published the discovery in The Wave Principle, the book that turned a private observation into a framework. But Elliott went further than pattern spotting. He proposed that markets obey natural laws, and that those laws could be measured with Fibonacci numbers. That was the radical part. He wasn't only saying market psychology exists, he was saying it can be quantified, and therefore anticipated. By the 1940s, he had pushed the idea well past the stock market. His second book, Nature's Law, The Secret of the Universe, argued that the same wave cycles govern growth and decay throughout nature, that what he had found in price charts was one expression of a universal rhythm. Ambitious, certainly, but it tells you how convinced he was that he had uncovered a law, not a trading trick. For a trader, the value is narrower and more useful than that. The waves give you a map of where you stand in the market's rhythm, so entries and exits come from your position in the cycle, instead of a reaction to the last candle. And because Elliott tied those waves to Fibonacci ratios, the map comes with coordinates, measuring both how far price should travel and how long a wave should take. Structure plus measurement. That's why his work still carries weight nearly a century later. Peter Lynch makes the same case with numbers. Market declines aren't the exception, they're the schedule.
But you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means that's a euphemism for losing a lot of money rapidly. But we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet, and they're doing fine. You're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own. So I think that's the key to element. Another key element is that you have plenty of time. People are in an unbelievable rush to buy a stock. I'll give you an example of a well-known company. Walmart went public in October of 1970. 1970 went public. Already had a great record. It had 15 years performance, great balance sheet. You could have waited 10 years saying you're a very conservative investor. You're not sure this Walmart can make it. You want to check. You see them operate in small towns. You're afraid they can only make it in 7 or 8 states. You want to wait till they go to more states. You keep waiting. You could have bought Walmart 10 years after they went public and made 35 times your money. If you bought it when they went public, you would have made 500 times your money. But you could have waited 10 years after Walmart went public and made over 30 times your money.
This is a clear example of how understanding the rhythm of market cycles can transform panic into opportunity. Elliott Wave Theory builds on this same principle, offering a structured way to anticipate price movements and act with greater confidence, rather than emotion. So that's why the theory matters. Now for how it actually works, and it starts with something surprisingly simple. Underneath all the labels and subdivisions, Elliott's entire framework rests on 2 building blocks, a 5-wave move that advances and a 3-wave move that pulls back. That 5-wave pattern is the foundation everything else is built on. Every rule, every guideline, every exception in the theory traces back to it. The market pushes forward in 5 waves, then corrects in 3. 5 up, 3 back. That single sequence is the market cycle in its simplest form, and once you can see it, the rest of the theory is detail added on top. The 5 waves that carry price in the direction of the trend are called motive waves, and they're labeled 1 through 5. The 3 that follow are the corrective phase, labeled A, B, and C. Break the large motive wave apart, and you find 5 smaller subwaves inside it. Break the correction apart, and you find 3. That gives us the 2 terms you'll hear constantly from here on. Impulse waves, which move with the larger trend, and corrective waves, which move against it. So waves 1, 3, 5, A, and C are impulse waves. They travel in the direction of the larger trend. Waves 2, 4, and B are corrective, pushing back against it. And here's the property that makes Elliott both powerful and frustrating. The pattern is fractal. The same 5-3 structure repeats inside itself at every scale. On a monthly chart or on a 5-minute chart, you're looking at the same shape, only the degree changes. That's what lets you read the broad market cycle and its smallest components with a single framework. In this illustration, you can see the basic 5-3 pattern repeating within itself across 3 different degrees. And notice how, as more degrees are revealed, the diagram stops looking like a diagram and starts looking like real price action. Beyond the basic 5-3 structure, Elliott gave the pattern a scale, what he called wave degrees. There are 9, from largest to smallest: the grand supercycle, the supercycle, the cycle, which spans years or decades, the primary, months to years, the intermediate, weeks to months, the minor, days to weeks, and then the minute, the minuet, and the subminuet. Don't try to memorize that list. The idea behind it is simply that the same pattern exists at every zoom level, and the names tell you which zoom you're on. In practice, tracking all 9 at once is impossible. Even 3 is difficult, because a single degree can support more than one valid count. Every Elliott wave is described by 3 elements: form, ratio, and time. Form is the 5-3 pattern we've just covered, and it comes first, always. Ratio is the vertical relationship between waves, how far price travels, measured with Fibonacci. Time is the horizontal relationship, how long each wave takes, and it follows Fibonacci proportions as well. Keep that hierarchy straight, because it saves you a lot of wasted effort. Reading the form correctly matters more than getting the ratios exact. A valid count with imperfect measurements is still tradable, while a precise measurement on the wrong count is worth nothing. With the structures and the degrees in place, we can turn to what keeps a wave count honest. And here, the theory treats 2 things very differently: rules and guidelines. Rules are inviolable. Break one and the count isn't debatable. It's invalid, so you throw it out and start again. Guidelines, like alternation and equality, which we'll cover later, are strong tendencies. You respect them, but a count survives breaking one. There are exactly 3 inviolable rules. Rule number 1, wave 2 must never retrace beyond the starting point of wave 1. If it does, the count is wrong and has to be redrawn. Rule number 2, wave 3 must not be the shortest of the 5 waves. In most cases, it's the longest and strongest of the sequence. And rule number 3, wave 4 must never overlap the price territory of wave 1. Any overlap invalidates the count. Those 3 do the heavy lifting, because they let you discard bad counts quickly instead of defending them. Beyond them, 2 further conditions define an impulse wave in the first place. First, every motive and impulse wave subdivides into 5 subwaves. If you count only 3, the issue isn't a broken rule, it's that you're not looking at an impulse at all. Second, wave 3 must always travel beyond the end of wave 1, while wave 5 doesn't have to surpass wave 3. It can fall short, and the count still stands. Let's walk through a simple example. In this valid wave count, wave 2 stays above the start of wave 1, so the first rule holds. Had it dipped below that level, the count would be dead on the spot. The second rule holds as well. Wave 3 isn't the shortest of the motive waves. When it is, the count is wrong, and usually for a specific reason. What you've labeled as wave 3 is really part of an extended wave from a lower degree. Wave 4, in turn, never retraces into wave 1's price territory, which satisfies the third rule. Any overlap there would invalidate the count. Then come the 2 conditions. Motive and impulse waves must consist of 5 subwaves, and each of them has to move with the larger trend. Fewer than 5, and the count is incorrect. If the count shows only 3 subwaves, it isn't an impulse at all. It's a correction wearing the wrong label. The second condition is that wave 3 must always travel beyond the end of wave 1. If it doesn't, the count is invalid. Wave 5 carries no such obligation, and that's exactly what a truncated wave 5 is. Wave 5 fails to surpass the end of wave 3, yet the count still stands, because wave 3 already did its job and cleared wave 1. Together, these 3 rules and 2 conditions are the filter every count has to pass before you risk money on it. Now let's take these rules to real price charts, where the theory meets live data. In this valid count, you can check all 3 at a glance. Wave 2 stays within its boundary, wave 3 isn't the shortest wave, and wave 4 doesn't overlap wave 1's territory. Clean and obvious. In hindsight, in real time, with the right edge of the chart still empty, it's a very different exercise. The rules are learned in an afternoon. Reading them live takes screen time. And one thing worth settling before we go further, Elliott's rules apply identically to bullish and bearish markets. Nothing inverts, nothing gets an exception. We'll work through bullish examples first, simply because they're easier to follow while you're learning the shapes. Once the structure is familiar, you flip it and everything holds. Now that the rules are in place, let's look more closely at motive waves and the forms they can take. There are 2, the impulse wave and the diagonal triangle. The impulse is the one we've been working with all along. It travels in the same direction as the wave of larger degree, which is why waves 1, 3, 5, A and C are impulsive, while waves 2, 4, and B correct against them. The diagonal triangle is the other form, also a motive wave, but one whose subwaves compress into a wedge instead of a clean thrust. It comes in two variations, leading and ending, and those names describe only position, where the diagonal sits in the cycle. A diagonal forming in wave 1 or in wave A is a leading diagonal because it opens the sequence, coming before the impulses that follow, waves 3 and 5 inside an impulse, or wave C inside a correction. The ending diagonal does the opposite. It completes the wave of the next higher degree and appears only in wave 5 or in wave C. In this image, we see a leading diagonal forming in wave 1, the subwaves compressing into a wedge marked by the converging lines. The other common home for a leading diagonal is wave A, and in this next example, the diagonal appears in wave 5, an ending diagonal, closing out the motive wave of the larger degree. Wave C is the other place an ending diagonal shows up, as you can see here. Now, both types are built from 5 waves, but they don't subdivide the same way. Leading diagonals come in 2 versions. The classic one alternates, 5, 3, 5, 3, 5. The second, less common, replaces every one of those with a 3, so all 5 waves subdivide into 3s. Ending diagonals only ever take that second form, 5 waves, each one a 3. And while diagonals usually contract, narrowing as they progress, they can also expand. The subwave rules hold either way. Here's an example of a rare expanding diagonal, where price reverses as soon as the 5th wave completes. The next image breaks that same structure down into its subwaves, and this raises one of the real challenges of wave counting. Degrees aren't always cleanly defined, which is what makes a live chart so much harder to read than a finished one. It also raises an exception. Remember Rule 3, wave 4 must never retrace into wave 1's territory. Inside a diagonal, that rule is suspended. There, wave the 4th of May pushed deep into wave 1's price territory, and in an ending diagonal, it almost always does. That overlap is part of what identifies the pattern. But the exception stops at the diagonal itself. Any impulse nested inside it still obeys the rule normally. With motive waves covered, we can move on to corrective waves, more intricate, more numerous, and as you'll see, the part of the theory where things get genuinely complicated. Now to corrective waves. There are 4 types: the zigzag, the flat, the triangle, and complex corrections, which aren't really a 4th pattern so much as combinations of the first 3. Start with the zigzag. It's a 5-3-5 structure. Wave A subdivides into 5 subwaves, wave B into 3, and wave C into 5 again. One rule governs it. Wave B must never retrace beyond the start of wave A, and one guideline: wave C usually extends past the end of wave A, though it isn't obliged to. From there, the pattern can stack. Double and triple zigzags are simply zigzags joined by an X wave, itself a 3-wave move. A double zigzag is 2 ABC structures linked by that X, the first labeled W, the second Y. In a triple zigzag, 3 ABC patterns are connected by 2 X waves, and the last one is labeled Z. You can already see how quickly this gets complicated. Next comes the flat, which has 3 subtypes: regular, expanded, and running. Every flat subdivides 3-3-5, and 2 rules apply. Wave A can never be a triangle, and wave C must unfold as either an impulse or a diagonal. The difference you notice first between a flat and a zigzag is wave B. In a flat, wave B retraces all the way back, near or beyond the start of wave A, and how far it goes is exactly what determines the subtype. In a regular flat, wave B ends near the start of wave A, and wave C finishes at or just beyond wave A's endpoint. In an expanded flat, wave B retraces beyond wave A, and wave C extends past it, what other schools of analysis call an expanded pivot. In a running flat, wave B still runs beyond wave A, but wave C falls short of it. The third corrective type is the triangle, and it comes in 2 forms: contracting and expanding. Contracting triangles have 3 subtypes: ascending, descending, and symmetrical. Expanding triangles have only 1, usually called the reverse symmetrical. A triangle unfolds in 5 waves, labeled A through E, with at least 4 of the 5 built as zigzags. The shapes are easy to tell apart. The ascending triangle has rising lows against flat highs. The descending has falling highs against flat lows. The symmetrical has falling highs and rising lows. And the expanding has rising highs and falling lows, higher highs and lower lows at once. One distinction separates the two families. In an expanding triangle, wave C can surpass the start of wave B, and triangles are picky about where they appear. Wave 4, wave B, the final leg of a double 3 or triple 3, or a wave X. What you almost never see is a triangle in wave 2, unless it's part of a larger complex correction. Now to complex corrections. Zigzags, flats, and triangles chained together and separated by X waves. Double threes are the simpler of the two, built on a WXY structure, and they take 6 forms: 2 flats, a flat and a zigzag, a flat and a triangle, 2 zigzags, a zigzag and a flat, or a zigzag and a triangle. Triple threes run WXYXZ and take 12, 3 flats, 2 flats and a zigzag, 2 flats and a triangle, a flat and 2 zigzags, 3 zigzags, and the remaining combinations of those same 3 patterns. The X waves that separate them can be any corrective type, zigzag, flat, or triangle, and you don't have to memorize 18 combinations, because a single rule generates all of them. A triangle never opens the sequence, and never appears twice. It only shows up as the final pattern. That's what caps the doubles at 6 and the triples at 12. It's also the honest warning about this corner of the theory. Applied live, across several wave degrees at once, this is where charts stop clarifying and start overwhelming. So before part 2, let's put down everything you don't need and keep what you do. The market advances in 5 waves and corrects in 3, at every degree. Motive waves travel with the trend. Corrective waves push against it. Wave 2 never retraces past the start of wave 1. Wave 3 is never the shortest. Wave 4 never overlaps wave 1. And a count that breaks any of those is simply wrong. And when a structure isn't clear, you are not obliged to force a label onto it. That's the usable core, and it's close to what David Paul was pointing at. Everything else we covered today is the map. Worth knowing it exists, worth recognizing on a chart, not worth a minute of memorizing. 9 degrees, 18 combinations, counts nested inside counts. That's where traders get hurt, trying to label everything. The ones who profit from Elliott learn the shapes, then ask a much simpler question. Where am I in the cycle, and what does that make more likely next? In part 2, we take it to the chart and make it pay. Wave extensions and truncations, the guidelines of alternation and equality, and then Fibonacci, how the ratios project where a wave should end in price and in time, how to stack them into confluence, and a complete trade read from divergence to reversal. Structure is what you learn today. Part 2 is what you do with it. So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the Lucro Trader community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the Lucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts. It's about mindset, discipline, and execution over time. Our main courses include smart money concepts, ICT, technical analysis, trading psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.